Welcome to Leaders in Housing Counseling, our call, the last call of the summer. Glad you all are joining us. Looks like we're going to have a very, very good turnout, and appreciate that a few of you told me that you're calling in for vacation, and that's fine. We think that's great. And the rest of us don't actually have a vacation, but I'm glad you're in place to do this work. So as you, I'm sure, know, this has been a lot leading up to this call, and so we're going to plan on it being an hour-and-a-half call, and if we need the time, we'll go a half an hour over our usual schedule. But rather than waiting for people to get on, we're going to get started right away because we've got a lot we want to cover, and we've already got 90 of you on, and that's great. Okay, so quickly on the agenda, we're just going to talk a little bit about the NHRC listserv because I know there's a lot of conversation about it recently. We're going to quick update on the NHRC surveys, our federal financing, and the NFMC sign-on letter. We'll spend almost the entire call on Home Ready and Framework. At the tail end, I'll just do a quick reminder about all the work we're doing on student loans and the trainings and joining NHRC. So we should be in great shape. So let's dive in. So really quickly, so the leaders list in housing counseling exploded a couple weeks ago, and I know a few of you were a little concerned about this, and we got a lot of, very, very nice, very supportive emails about people not wanting to be removed from the list and all that good stuff. We're in great shape, and it's a great list, and it's a very dynamic list, and we have 1,300, almost 1,400 people on the list right now, and they're all program managers and executive directors. This list is thriving and healthy and doing quite well, so please don't worry about it. I do want to say that, exploding like that is very helpful to us because it tells us what's important and elevates issues from the field. And this was an incredibly valuable conversation. Really, we ended up postponing all the guests we had for today's call and assigning it to Home Ready because this is clearly top on everybody's list. So we're glad to do that, and that's how we learn, and I think you elevated lots of important issues. We took a lot of the emails you did and sent them to Fannie Mae so they could see and get a taste of what people were thinking about and saying, and so some of them you sent to us individually and some were posted on, but we got as many as we could to the list. We didn't send everything, but we got a good selection, I think. If you do think that there are too many emails, if you really don't want to see the explosion, and it only seems to happen about once a year, if you really feel strongly about it, you can get onto our headlines list. And so that's the same list, except it only, it doesn't allow you to reply. So it's really just what NHRC puts out, and occasionally somebody else can get in on it. But it's meant to be really much less traffic, and it's a so, if you need to, shoot an email to Matthew, and he can take you off one and put you onto the other. But really appreciate your input and your involvement on the leaders list. It's all a learning experience, and I accept that democracy is a messy business, and I'm delighted that we're in it, and really appreciate your input. And on that note, a couple things. One is just the list etiquette. I don't think I really need to say this to you guys because you guys are all great about this, but there are a few people who do post the kind of remove me or me too's on the list, and none of that needs to show up there. We really do want people to post content about responding and thoughtful responses, and we're not trying to take a vote on the list. We're trying to get ideas out. We're trying to get different perspectives out. I do also want to say that we don't have to have consensus. If we've got a broad range of opinions and different interests, do not feel bad about saying, I really respect what so-and-so said, but I feel like this. And we can handle, and we do have a broad range of organizations and philosophies. That's great. That's part of who we are. And when we deal with institutions like HUD or whatever, we sometimes just tell them the broad range of what people think, and sometimes we have a consensus opinion, and sometimes we just have a range. And I think we should be comfortable with all that, and you should be comfortable being on it, contributing to that conversation. And on that note also, today we're going to have, in the Home Ready discussion, the key thing is that for you is please feel free to use the question box to make comments and or to raise questions. We're going to try to get to as many as we can, and I think we're going to also give them to Fannie Mae and to Framework so that they can, if we didn't get to everything, we'll be able to at least make sure that people get the input. Okay, so very quickly, NHRC surveys. So we're having a great job on the credit report pricing and discount survey. I'm very eager to get this going. It would be helpful if you are a big user, if you do, 800, 1,000, 2,000, 10,000 credit reports. We'd really be helpful to get your input on this survey right now. Glad to have others as well. We're doing really well there. On the NHRC, just tell us what you're interested in. We need to hear from more of you. This is just vital to us. I posted what the survey is so you can think about it ahead of time. Maybe if a few of you want to talk about it at a staff meeting or something, that would be great. But we've gotten some very thoughtful, very interesting comments, and I'm eager. I check this list every day. I will read them. Matthew will read them. We really are taking this pretty seriously, so it would be great if you could take a few minutes and give us some of your thoughts on the survey. And it's about projects we should be working on. It's about our national meeting and how long should it be, and just some of it's mechanical, some of it's really just big ideas and thinking. So eager to get all that in place. And then our usual topic, going to federal funding and for housing counseling. Matthew, what have we got?
Just to update folks on the sign-on letter that we've mentioned the last, I think, couple calls. It's going to go to the Senate. As folks know, the Senate Appropriations Committee had zeroed out funding for the NFMC program. The House had funded it at $42 million, so we're going to send the letter to the Senate asking them to move towards the House's number. We've mentioned in the past with other sign-on letters, we've been setting increasingly ambitious goals, and I think the last letter that we did early in this budget season, I think was the first one where we had all 50 states represented, and so that's kind of the goal that we're going for. So you'll see the states listed there that we're missing signers from. Going to do direct outreach, but if you're from one of those states, some of them are not surprising. Obviously, they're pretty sparsely populated, but Rhode Island, Vermont, maybe there's some folks on the call from. So if you are, we absolutely would love to have your support, and we'll circulate an email with the information on how you can sign your organization on after the call.
Great, and I've heard from a couple groups saying, well, I don't get NFMC funding anymore. Well, we'd really like you to support your brother and sister organizations on this, because we do need, the crisis, as we all know, is not over, and having organizations able to address the people in trouble still is very, very valuable. So please feel free to sign on without having necessarily be an NFMC funded organization. All right. Well, we did that rapid fire, and so let's go on to the topic at hand. So as we all know, Home Ready is the new Fannie Mae product, and Framework is the channel through which the education is going to be delivered. We have Joe Weisbord, as well as Christy Waters and Lindsay Reidenbach from Fannie Mae with us, and we have Danielle Samelin from Housing Partnership Network, a longtime veteran in our field, and she's also the president of Framework. And what we wanted to do is really kind of get a good overview of the Home Ready product, and then really devote a good, and then some of the Framework perspective as well, but devote a good part of this call to really kind of discussing the elements, its implications for housing counseling and for home buyer education and for our field and for our home buyers and homeowners. And wanted to really try to see if we can't get your input into this whole discussion as well, so that we're both hitting the issues that we need to be hitting, and you're getting the information that you need. And I do really want to say that this is, I think, a major opportunity in our field to be able to get a new product that has a lot of innovation in it, and in a very credit-constricted environment right now, where we are struggling to get good product for people. This creates opportunities for us, and I think we, as an industry or as a community, need to really figure out how to make it work the best for our clients and for our organizations. So I think this represents lots of big opportunities. So with that note, welcome Joe, Christy, Lindsay, and Danielle. Let me turn it over to you all.
Bruce, thank you so much, and thanks to all the folks that have joined today. I'm really impressed just to hear the story about the growth of this network and organization. You guys have become a significant force in the industry, and the input that we've gotten directly from NHRC, as well as from a number of you, the organizations that participate individually, and your respective national networks, has really been instrumental in shaping what we're trying to do with Home Ready. We're really excited about this. It's the culmination of a year or more of work that really started when our senior leadership, our board of directors, and our regulator really said, we need to refocus on access to credit. As Bruce just mentioned, there are still a lot of homeowners out there that are struggling in the wake of the recession and the mortgage crisis, but we really, as much as that's an ongoing challenge, we've kind of got our arms wrapped around that, and we really need to pivot and focus on the untapped opportunities for people to become homeowners again, and particularly to communities and segments of the market that really haven't been served as well as they could be. And that's really the impetus for Home Ready, is really a focus on lower income borrowers, on communities of color, on younger borrowers, and as you all know, probably as well or better than we do, the whole landscape of home ownership has changed, and the way that people live and the way that they aggregate income and meet their needs for housing and other essentials is changing, and we need to evolve the mortgage system to meet those needs. And so Home Ready is an important step in that direction. I think John Lawless, who's led this effort within the company, is always the first one to say it's a step forward. It's not the last word, it's the first word. And so the questions that you all have posed and shared with us through the listserv, and I'm just back from vacation, so I haven't even been able to go through everything that Bruce shared with us, but that's really, really valuable, because this is still something that we're going to be tracking and monitoring very, very closely, looking at how it's impacting the marketplace, who we're serving, who we're not serving, and looking at how we can make adjustments over time. So not just to the homeownership education counseling components, but to the overall product parameters. I want to let Christy Waters, who probably knows more about affordable lending. She's probably forgotten more about affordable lending than I'll ever know, from our credit policy team, walk you through some of the kind of key product features. Then I'll speak to the homeownership education component, and then ask our partner Danielle Samlin from Framework to talk about the Framework network, and particularly how organizations can participate that and add framework to their array of tools to serve consumers. So let me stop there, and I can't click the slides, Bruce or Matthew. If you guys can click forward a couple slides.
And I'll just mention, Christy, it looks like you have yourself muted, and I can't unmute you. You're muted through the GoToWebinar, so if you can, you need to unmute yourself. And Joe, am I on the right slide?
Yeah. Yep.
There we go. We should have Christy.
Is Christy on now?
Yes, I'm here. You can.
Okay, great.
Can you hear me now?
And,
okay.
Yes.
Yep. And the one thing I just say, this we just made this announcement. We're in the process of developing the detailed guidance for lenders that will come out at the end of this month. And this product actually won't be live in our automated underwriting system, DU, until December. So what you're seeing is, high level. There will certainly be some questions we won't be able to answer because we're still working on them. And the PowerPoint slides that you're looking at are aimed at lenders. So just, we will eventually have a version of these materials to, once all the details are finalized, we're going to do a lot of work to get the word out to counseling organizations and other nonprofits that are serving consumers directly, so that you can make this available to the folks you serve. But don't be offended that this is the lender-centric version. So Christy, you want to
Sure.
share just the big picture on Home Ready?
Sure. So I can talk about Home Ready. It's been a long time. My community mortgage has been out in the market for many, many years. So when we decided to sit down and really revamp MCM to make it more relevant in this market, we spent a lot of time really listening to lenders, listening to other industry partners, looking at the borrower demographics and how they've changed over time, and where are we maybe not meeting a need that needs to be met. So what I'm going to talk about here is I'm really going to highlight a lot of the changes that we've made, and then also be sure to highlight the things that haven't changed, because there still was a lot of good left in our My Community Mortgage product, and a lot of features that were very valued by the industry and really helped borrowers achieve home ownership. So we really wanted to strike the right balance. We didn't want to give new features and then take away other features, so we have retained a lot of what is in existing MCM. So if I could ask you to switch to the next slide. So on this slide, this talks about the borrower benefits. One thing we've done, low down payment. So we're going to offer up to 97% financing for purchases. This is a DU-only functionality. It's something that we brought back to the market late last year from a holistic standpoint. But with Home Ready, what we've done is we no longer require there to be a first-time home buyer on the loan in order to obtain the 97% LTV financing. And this will be a unique feature of Home Ready that is not available in our standard product offering. They can go to 97. Here, you don't need that first-time home buyer to obtain that level. Flexible sources of funds. This is something that's not changing. Today, we provide a lot of flexibility to the industry and the source of borrower funds. Gifts, grants, community seconds to assist with down payment and closing costs with no minimum borrower contribution required from the borrower's own funds, and those flexibilities are being retained. MI, we offer all types of MI. That's something we offer today. I want to talk homeownership education. I don't know, Joe, I'll ask you if we want to cover it here or if you would rather cover that.
Yeah, I'm going to cover that after you hit the main product features.
All right, so if we go to the next slide, One of the things when we sat down to think about Home Ready and we thought about the borrower demographics, one thing we did is we refocused our borrower eligibility based on area median income requirements. So today, My Community Mortgage has a set of AMI median income requirements. What we've done here is we've aligned those with our housing goals requirements. Don't anticipate there will be a lot of change or a reduction in eligible borrowers, but I did just want to highlight that we never used to have areas where there was no income limit, and with Home Ready we will. In low-income census tracts, there will be no borrower income limit to be eligible for this product. We will allow up to 100% AMI for the high minority census tracts in the disaster areas, and then everything else would default to the 80% of AMI. And to the right there, we do provide you some information about our analysis of the census tracts in the U.S. Where each of these limits would be applicable.
And
we can go to the
just, Christy, I just want to jump. There's some great maps that were developed by some of our colleagues. There's a map actually for each state that shows the location of the census tracts that fall into the various categories. So you can go on to and I don't have the link right off the top of my head, but we can get it to you, Bruce, to share. But you can look at a map of the states that of your state and see, roughly where the different eligibility criteria fall.
Well, good. We'll distribute these slides after the call, and we can include that link as well.
Great.
Okay. So if we can proceed to the next slide. We're going to talk just in a little more detail about some of these product features. DU will have functionality that will assist lenders in identifying potentially eligible borrowers for our Home Ready product. So from a lender perspective, you have to select the product in DU, and what we'll do to ensure that the maximum number of borrowers who could qualify for this product and the advantages of this product are identified, we will message that lender and let them know if the borrower's characteristics, including their qualifying income relative to the AMI in that area, it would appear that they would be eligible for Home Ready. We'll message the lender, and then the lender and the borrower will decide. Underwriting flexibility is one of the most exciting, innovative new features that we're offering here. Really acknowledges the fact that our borrower demographics are changing. We have a lot more extended living arrangements, primarily in low income or more concentrated in minority households where we have the borrower living maybe with a parent or a child, and we really wanted to be able to provide some functionality to help support those borrowers because we don't really see that in the market today. So non-borrower household income is the reference to this level of eligibility. If there is a non-borrower household member who is also a family member that's living with our borrower, we will allow the existence of that member as a compensating factor in DU to allow our borrower to have a DTI greater than 45 to 50%. The non-borrower household member, they're not contributing income. It's not added to the qualifying income. This is based on the premise that we have a relative living with the borrower, allow the borrower to have that higher DTI. Our own research indicates that in these types of situations, the non-borrower household members do contribute to income, and that income stability is not that much different from other types of living arrangements. So we're going to acknowledge these types of arrangements and allow this higher DTI to expand access to credit. Another thing with Home Ready that's not eligible for MCM today is we're going to allow non-occupant borrowers. So someone else on the loan who's not going to occupy the property, their full income, assets, credits, liabilities, everything will be considered. They are a borrower on the loan. There won't be any separate DTI calculation or qualifying for the occupant borrower. We're also going to allow a new feature for Home Ready, rental income from an accessory unit. So we have a one-unit property that has a basement apartment. We will allow that borrower to use that rental income that's generated as part of their qualifying income, and this will be a feature that is unique to Home Ready. It will not be eligible outside of that product. So we can advance to the next slide.
Christy, would you rather save some questions for the end, or I have had a few come in on the slide that you just did. Do you want to take those now or wait?
I'd love to take them now just because they'll be most relevant.
Okay, so could you talk, this is from Ellie Pepper, could you talk more about the lender's ability to choose whether or not to offer the loan to a buyer who is potentially eligible in DU?
Okay, so DU will message. If the lender goes into DU, let's just talk through a scenario. The lender goes into DU, they don't select Home Ready. They select standard product. They're going to get this message now that says, I've done the hard work for you. I'm telling you the total qualifying income you've entered versus AMI in this area makes this borrower potentially eligible for Home Ready. We view absolute product selection as a discussion between lenders and borrowers. There could be a reason why the borrower, maybe he's coming with a lot of down payment, maybe there's another reason why they would not be eligible for Home Ready. Maybe it's more advantageous for them not to take Home Ready. But we really view the product selection between the lender and the borrower. So we don't say you have to submit it as a Home Ready, but we are at least telling the lender, we've done a lot of the legwork for you in DU based on the information you've entered, and this borrower would be eligible based primarily on the AMI calculation.
So it doesn't require that the lender offer that, and the lender, but unlike the previous under MCM, the lender had to start their entry into DU by flagging it as a potential MCM loan. So this is going to broaden the awareness among lenders to every lender we do business with that Home Ready is available, and whenever it's a possible option, it'll be flagged. So we think it's going to encourage a lot more lenders to participate in affordable, in our affordable product generally, and make it available to a lot more borrowers. The other thing that I guess is related to this and is the pricing is really simplified, and it will consistently be better or equal to our standard product for Home Ready. Under MCM, it was really confusing. There were places where it was better, there were places where it wasn't as good, and it created a lot of confusion for lenders because they had to do an analysis of every loan to determine that. But as Christy said, the ultimate underwriting decision is the lender's responsibility. DU we don't make a decision for them. We provide them with information, and they have to make that selection in consultation with the borrower.
Great, I think that's helpful. Then from Kendall Reed, the question is, if they're using non-borrower income, does the non-borrower go on the note or the mortgage?
Okay, so the non-borrower is not a borrower. Their income is not used for qualifying. They're not applying for credit, so they will not be on the mortgage loan application, and they will not be on the note or mortgage documents. It's their mere existence of living in the household that we use as a compensating factor to allow the actual borrower who is applying for credit to have a higher debt-to-income ratio.
So the grandmother who's contributing her Social Security check into the family income pool, but it's not on the mortgage, could be considered. Or the income could be considered.
That's
exactly just for the total DTI.
Just to allow to underwrite at a higher DTI.
Right, but we're not adding the grandmother's income to the qualifying income. We're not. We're just saying she lives there. She has a source of income. So borrower, you have this additional family support that lives with you, so I'm going to let you, borrower, based on your income alone, have a higher debt-to-income ratio to qualify for this property.
And this is, just should mention, we didn't sort of arrive at this, kind of pull this out of the air one day. One of the economists at Fannie Mae who'd actually had some personal experience in extended family households started to delve into this and looked at the data from a number of different data sets over several decades, and what he found was that one was, and again, this probably is not a surprise to a lot of the folks on this call, but we found that the extended family households were very stable over time, and two, that their total aggregate income, in fact, was less volatile than if you looked at the income of just borrowers on mortgages. So the presence of additional adults with significant income in the household actually provides a more stable total income stream in that household versus just the borrowers themselves. So when we thought about this, it presented a lot of problems to actually add the income in, because then they essentially become a borrower. But to treat it as a compensating factor and underwrite it a higher DTI was the way that we wanted to recognize that that benefit.
So actually, let me jump in here on your final point about the rental income. So I'm in Boston, and I've got a 3-decker, and so I live on one of the units, and then the other two are paying rent in. So how is the rental income handled in that situation?
So I may not be as familiar with the terminology, but there's two differences. So we allow 2 to 4 unit properties under MCM today, and will continue to do so under Home Ready. So that's sort of a property designation made by the appraiser. If you are considered a 2-unit, whereas accessory dwellings are 1-unit properties that have a basement apartment. Either way, either the accessory dwelling that we're adding here or the 2 to 4s that we offer today, the rental income generated can be considered for qualifying. In a purchase transaction, you don't have a history of receiving rent on that property, and we have guidelines that basically state it's the lesser of the actual rent you're going to receive based on the lease agreement, the lesser of 75% of, the actual rent you're going to receive, or the appraiser's opinion of the market rents in that area. And then if you have a history of receiving it, and say you're doing a refinance under our Home Ready product, then we would look to your tax returns and that information under our standard guidelines. There's no special calculation for rental income for Home Ready. It would be the same way we calculate rental income on any other product that we offer.
And you would treat it as household income rather than deducting it from the monthly mortgage payment.
On 2 to 4s, we count your mortgage payment and then we give you credit for the income. So it balances itself out, yes. You'd get credit for the monthly rental income, and plus then in your liabilities you would get your PITI for the property. So you get credit on both sides of your DTI for it. But it balances itself out essentially.
Well, actually, we should probably explore that at some length. There's a lot of innovation that happened in the 90s with PITI reductions, which were very successful. But this is still very good stuff. And then the distinction when you say an accessory dwelling, so this you described it as a basement apartment. So that's different than a 2 or 3 unit building, but it's like a mother-in-law or something like that. Is that a mother-in-law unit?
Exactly.
And the distinction is really made by the appraiser. Yes. Yes.
So that's actually very good, because it's often very hard to get that to be recognized on single-family properties.
And the appraiser is making the determination for 1 unit with accessory dwelling versus a 2-unit property. The appraiser does that. Today, we don't allow any rental income from an accessory dwelling at all. But for Home Ready, this is where we're going to provide that flexibility.
So this is, yeah, for the people that this affects, it's a big deal.
Yep. So just going back to the DTI for 1 second, have you determined, so when there's that non-borrower income being taken into account for letting the the person exceed the DTI, have you determined how high they'll be able to go?
Just to 50%. That's the maximum.
All right. And just one other question. This is from Luis Mack. If the person had a part-time job for 3 years, would they be eligible if that income supports the loan and the parent is a non-occupant?
Okay, so our borrower's been working part-time for 3 years, and we have a non-occupant borrower on the loan as well, who's the parent.
I think
yes.
that's the scenario, yes.
All that income, assets, liabilities, and credit of both the borrower and the non-occupant borrower will now be considered by DU and will allow a maximum LTV of 95%. So there won't be any separate qualifying for that borrower. We will combine all the aspects of underwriting between the borrower and the non-borrower, or the borrower and the non-occupant borrower.
Occupant and the non.
So it's like both of them are borrowers, so we're going to just smush everything together and qualify you as a whole. And that's a big change for us. And allow it to be done in DU, and allow the LTV to 95 for those.
So the way that folks should think about it is that we're really not making a distinction between an occupant and a non-occupant. It's as if the parent lived in the home.
Great. Good. And just one more DTI, although the questions are trickling in, but from John Bonin, so his question is about when they're not submitting through DU, when they're doing a hand-calculated pre-qualification, what are the standard ratios you use for DTI?
Our maximum will be 45%.
So they're asking about manual underwriting?
Yes.
Yes.
Okay.
Manual underwriting would still be capped at 45%, and in addition, we may not have mentioned, the non-borrower household functionality is a DU-only flexibility. And the reason that is, today in DU we allow certain borrowers to go to a 50% DTI, whereas manual is capped at 45. We're keeping that construct in place and really just sort of amending what the compensating factor would be to allow this additional flexibility for Home Ready. But maximum manual underwriting DTI is 45. If you want to go above 45, you've got to be in DU. And the borrower demographic we're going after with Home Ready, this will be the compensating factor within DU to allow that higher DTI.
Great. And just one more question from Kendall Reed. So again, when there's a non-occupant borrower, can the non-occupant borrower own another home, or how would that impact?
It's a great question.
Yeah.
So MCM today, no one on the loan can own any other property. That will remain, but only applicable to the occupant borrower. The non-occupant borrower that's been added to the loan will not be subject to that limitation and can own other property.
Great, thank you. That's all for questions now.
All right, so let's move to the next slide. Okay, so we've touched on some of these. A big one we haven't touched on is the fact that today under MCM you cannot do any loans that are secured by manufactured housing, and we don't really have any renovation features available under MCM. We will allow the combination of Home Ready with the manufactured housing property type. Now we will apply the standard manufactured housing eligibility and requirements. So you're still going to have to underwrite it through DU. You're still going to be capped at an LTV and CLTV of 95%. But the fact that we're allowing the combination does provide a benefit to these borrowers. The other thing we'll also do is allow the combination of our standard home style renovation mortgage product with Home Ready up to Home Style's maximum of 95% LTV and CLTV. Now, I don't know that everyone's familiar with home style renovation. It is in the guide, but it does require a special lender approval to participate. But being able to combine all of the flexibilities and features of both products we think is a real win for the industry and for borrowers. Non-traditional credit, none of our guidelines are changing. They are what they are today. You have all of that flexibility available like you would under MCM today, 3 sources versus 4 sources and so on. We've talked a little about the MI and pricing.
Well, just hang on for a second. So a non-traditional credit. So how does that work in terms of, so how does this all fit in with credit score? And people who have non-traditional credit often don't have much of any credit score. So how does it all work?
So non-traditional credit in the purest sense is borrowers that have no credit score. We have some additional flexibilities I can talk about that will be retained for maybe someone who has a low credit score because he doesn't have a lot of credit. So non-traditional credit here, you don't have any credit, you don't have a credit report, you don't have a credit score. We will allow you to develop that non-traditional credit profile. Under HomeReady, you only need 3 sources versus our standard 4 sources outside of the product. One has to be housing related, one is a utility, and then one is, you know, any other kind of credit, gym membership or cell phone bill. For HomeReady, we will retain the NCM flexibility I think that you may be speaking about, where a borrower does have a credit score. It's lower than the minimum credit score required, but it's clear from the credit report based on the reason codes that that's because he doesn't have a lot of credit. His credit has not been opened very long. So these are borrowers we would typically see with one trade line that's been open for, you know, let's just say 2 months. He doesn't have bad credit, he just doesn't have a lot of credit. So we do currently and will continue to provide the flexibility for those borrowers to be eligible as well in the manual underwriting space. You would go ahead and supplement that minimal amount of credit they have appearing with non-traditional credit and be able to deliver that loan even though his FICO is below our absolute minimum of 620. Does that answer the question, or?
Well, I mean, that does. Just one more sentence on this just to understand it. But if somebody has, for example, a year or 2 but a very thin file, can alternative credit boost that up, or is that not the, I mean, that's I think what we see more often than somebody who just has 2 months.
Right. I was just using that as an example. You would want to be sure that the reason codes on the credit report for why that score is low is because he doesn't have an established history. He doesn't have a lot of sources of credit. What we wouldn't want to do is set up a borrower who has sufficient amount of credit and has demonstrated an unacceptable credit history and then being able to supplement him with non-traditional credit.
Good, but in situations where people, so culturally, some people don't want to have lots of credit, think that that's a mistake, and you know, but pay their bills, pay them on time, pay them as cash, and often alternative credit was a great help for those people, but it didn't mean they didn't. I mean, in today's world, it's hard to not have a credit score. But they're disadvantaged because they don't have a lot of trade lines, and they don't probably have the variety of credits that the credit scores like. And we use that to compensate for those people. I think that's a point.
And we have the policy. I could send you more details about the policy as a follow-up. It is in the selling guide today. It's been out there since around 2009, 2010, and we really don't get a lot of traction in that space. But it really comes down to the reason codes on the credit report, I'll just tell you, should be your guide about whether or not these borrowers fit into this. I'm lower than 620 because I don't have a lot of credit versus the borrowers that have enough credit and really haven't demonstrated responsibility in that space. So yes.
And I should just add that this is an area where there's a lot of research and focus longer term, looking at one of the things that FHFA's asked both GSEs to look at under the scorecard is alternative credit scoring models, and just generally how do we address the broader diversity of credit histories and some of the cultural factors, Bruce, that you were just mentioning, and try to create effective underwriting frameworks for those households. So there's a lot going on in this space, beyond what our current policy is.
And could you all just repeat quickly if you're not using non-traditional credit, what the minimum credit scores are?
So if you're going to underwrite through DU, the minimum credit score would be 620. If you're doing any kind of manual underwriting, our general baseline is a minimum of 620, but our manual underwriting eligibility is tiered by many factors. So I can't quote you a one credit score. It's really tiered based on whether you're taking a fixed rate mortgage or an adjustable rate. It's based on the number of reserves as well as the borrower's DTI, and that is available on our website. We could give you a link so you can take a look at that. For me to go over it here and give you all of the different twists and turns would be hard. I just say 620 is minimum for fixed rate mortgages in the manual space. We do have a 640 minimum for adjustable rate mortgages in the manual space, and DU is a minimum 620 across the board.
And if this is an area that there's a lot of interest, you know, we could follow up with you know, both provide the link, but you know, maybe do some if there's some subset of folks that are really particularly interested in this or see a lot of borrowers in these circumstances, that we could, you know, do some provide some more intensive information.
Real world examples are very helpful.
We would love to delve into this at some length. I mean, yes. I mean, I think the problem is for people that credit scores are in average, and we definitely understand that somebody has a lower credit score below 600. We understand the odds game that they're not going to be paying on time, but in fact we find very good, very capable people who are in that category who, for a variety of explainable reasons, have a score that'd be lower than what we think they should in terms of qualifying. And you know, that would be great to spend some time on that. It'd be very interesting.
And you know, I think that the policy, you know, provides for, you know, a fair amount of flexibility. I think, and one thing that if members of NHRC have lender relationships and they have lenders in their community that really have been good partners in working with people with non-traditional credit backgrounds, we'd love to know about those, because as Christy said, we don't see a lot of this, and part of it is I think lenders don't, you know, either they're not comfortable with it, they don't have strong expertise in the area, or they're just not focused on this business. So you know, as Christy said, real world examples and willing partners are terrific.
So that's a challenge we should try to pick up on. So if we have some stellar lenders out there who are doing a lot of good work in non-traditional credit, please email Matthew and me, put it in the box, however you want to communicate it. Actually, doing that as an email would be good because we can follow up easily. That's an important area for us. And there was a lot of this lending done in the 1990s and early 2000s, but I think we've lost a lot of ground here. Good.
And we do business with, you know, 2,000 lenders, and so it's often, you know, what's going on the ground in local communities. Sometimes you may have a better touch on that than we do, and we really want to know about the lenders that are doing this business, because, you know, there may be opportunities to provide further support to them and help them grow it.
Excellent.
So I believe the next slide starts with our home ownership education, and I'll pass it back over to you, Joe.
Thanks, Christy.
And just, I'm sorry, just one quick question is whether there's an age limit on manufactured housing.
And is that the buyer's age or the unit, the building? I
think they mean the building. I hope they mean the building age.
I have to look it up because I have to admit that even though I am a credit and risk person, I don't know all of the guidelines around MH. This is not chattel. We can follow up with that
after the call.
Yeah, it is.
This is real property, not chattel.
Yeah, it has to be titled as real property, and it has to meet the basic. Isn't there the HUD criteria?
Yes.
I can't remember the standard.
We'll follow up and give you some additional information.
But you should go provide a quick definition of the difference between real and chattel property.
Chattel is still movable and still has wheels and is not attached to a permanent foundation, and that would not be eligible. MH that's been converted to real property and is also affixed to a permanent foundation would be eligible in the purest, most simple form of explanation. Hope that helps. Okay.
And the folks that are, for folks that are interested in manufactured housing and all of the issues around it as a source of affordable housing, CFED is a great resource on that, and they're doing great work and advocacy to enhance enhance that as an option for people. Thanks. Christy, and you could, if people kept asking questions, you would not be able to exhaust Christy's knowledge of this stuff. So I'm really appreciative of her joining us today. Why don't you go ahead and flip to the next slide, and I want to talk a little bit about the homeownership education requirements and the two things that I want to just highlight up front. One is that when we looked at our overall, when we started working on this, we looked at overall all of the loans that we acquire, how many are flagged as having some form of homeownership education or counseling, and it was a really disappointingly small percentage. And I think one of the challenges for the counseling field is we kind of shift the perception of consumers and lenders more broadly to stop sort of thinking about homeownership education and counseling as kind of bad tasting medicine that you have to take if you want to get down payment assistance or an affordable mortgage, and really shift that to a more of a mainstream type of thing that anybody who was making an enormous investment like home ownership would avail themselves of. And what's interesting, and again you all know this, is that any of your clients would say, this is, how could I have not, taken this, how could I have not availed myself of counseling or homeownership education? There were so many things I didn't know. This has kept me out of trouble. And yet, most people go forward with a huge investment, huge responsibility, huge financial risk, with relatively little knowledge or support. So one of the things that we really are hoping to accomplish with HomeReady is to really, take some steps toward broadening the reach of homeownership education and reaching more people, and at least taking a step toward more of a mainstreaming of that resource for consumers. So one of the key changes here is that historically we've focused on homeownership education as only applicable to first-time home buyers. Under HomeReady, it's applicable to all borrowers. So first-time buyers, repeat buyers, refis, there's a minimum level of homeownership education, and it's think of it as the minimum level for a mortgage-ready borrower that is required, and we are providing that through the Framework online system as the main channel. One of the things that we also looked at when we looked at our overall results on homeownership education and counseling was that a significant share was going to the MI, to the resources provided by the MI companies. And some of the MI companies provide, decent education programs. Some of them provide pretty thin offerings, but there's certainly no consistency. And I think there was a concern that NHRC's raised, HUD had raised, and others about a party that has some financial interest in the mortgage transaction also providing the education. We really took that feedback to heart, and are only allowing education that's provided via HUD-approved nonprofit agencies who are independent and unbiased. So we think those are, important steps toward, reaching a much wider population, the people that were using the MIs and the people that weren't traditionally covered under homeownership education because they weren't first-time home buyers, really expands the universe significantly. Let me just share a little bit more on some of our criteria in thinking about this, because we spent a lot of time reaching out to the counseling community, to local agencies, as well as national organizations. We spent a lot of time talking to lenders and other industry stakeholders, and our sort of number one criteria was, how do we ensure some basic level of access to consistent, high-quality, independent education and counseling for consumers? So that was kind of our first criteria, that there's some minimum standard of high-quality education that consumers can access easily. The second criteria is that part of the reason that lenders so frequently were defaulting back to the MIs was that it was just simple and efficient for them. And so we had to make this something that was easy for lenders to understand and implement. We got a lot of feedback that our policies were too confusing. They didn't understand, who was eligible to provide. So we wanted to make it simple and efficient. We wanted to ensure there was flexibility, so consumers could access it through a variety of channels. We all know consumers come to homeownership through a lot of different directions. Some go to a lender first, some go to a counseling agency first, some go to a realtor first, some go to Zillow first. We wanted to make sure that however people were entering the process, that they would be able to access, again, a standard quality. Last two criteria is that we wanted to be able to leverage the array of HUD-approved counseling agencies that operate in this space and provide high-quality support to consumers. So whatever we did had to be able to integrate and had to have a way for agencies to participate. And last was the ability to implement a post-purchase support program. When we looked at and we talked to independent experts on counseling that had done independent research, one of the things that came up consistently was that the availability of post-purchase support, even if it was very light touch, text message, email reminders, tips, reminders of the availability of counseling if you got into trouble, made a difference in loan performance and outcomes for consumers. So that was one of the things that we wanted to make sure we could incorporate. And that really is how we ended up focusing on framework to provide a single, simple channel that was understandable for consumers and lenders, that has an open network that a wide range of HUD-approved counseling agencies can participate in, and I'm going to turn this to Danielle in a second to talk about how that works, and that could implement a post-purchase support program for consumers that was independent and differentiated from what follow-up communication that they might get from their lender who's trying to cross-sell them products, or from their servicer who's really focused on their mortgage payments. So just wanted to share that sort of that thought process with folks as how we arrived at this approach. The two other things. One is that Framework has a fee that consumers pay of $75, and one of the pieces of feedback that we got almost I can't say from every HUD agency that we spoke to, but from the large majority, was that they supported the idea of consumers paying for pre-purchase assistance, but that they had trouble implementing it because they were concerned that if they implemented it, someone else wouldn't, and they would lose clients to whoever was offering it for free. I think our hope is, one is we think there's some value in consumers making a modest commitment up front, and investing some time and a little bit of money to really test their commitment, and secondly, that it hopefully starts to reset expectations around the value and enable the industry to implement consumer pay, on a broader basis. So the last thing I want to mention is that we view this as the minimum level of homeownership education for a mortgage-ready buyer. This does not take the place of the types of one-on-one counseling that I'm sure most of the organizations on this call do, where they're working with a potential buyer to get them to mortgage readiness, working with them on their budget, on credit repair, on financial planning, and so this doesn't take the place of that. This is the requirement for this product, and we view that upfront counseling as a high-value activity, but much more complicated to implement at scale, and are trying to figure out how we can further leverage that work to bring more people into the system. So I wanted to make sure that seemed like it was one of the concerns, is that this somehow is the same as counseling or takes the place of counseling. That's clearly that's the furthest thing from our mind. And I guess I should mention one other thing that a lot of people have mentioned is that online isn't appropriate for everybody. And this was an issue actually Framework raised with us, and they said, we're really thrilled that you want to work with us, but online isn't right for everyone. There may be people for whom just basic issues like internet access, having an online payment method, a vision disability, a learning disability, a preferred language other than English or Spanish, or other reasons that this isn't the best choice. And so one of the things we're working on is to create a clear alternative route for home buyers for whom this doesn't meet the needs of. But again, a large number of our MCM borrowers were going through the MI, so they were accessing online and they were using it, and this will bring those borrowers to a better quality, independent education, even where we create a carve-out for potential home buyers for whom this isn't an appropriate choice. I'll stop there. I've said a lot. And Bruce, are there questions, or otherwise, let's flip it to Danielle to talk about the Framework Counseling Network and how organizations can leverage that and participate.
Well, let me do one quick shout out, which is that on top of what you just described, Fannie Mae also has decided that housing counseling would only be provided by HUD-approved housing counseling agencies. And we think that's a huge step forward, and warm pat on the back, and excellently done. We think this is an important step forward for our work. But on that note, Danielle, do you want to pick it up?
Sure. And I know we're way over time, so I'll keep this quick, and anyone can follow up with me. You probably have my contact information, and then we also have a partners@frameworkhomeownership.org email address, and anyone can email that, and someone will get back in touch with you. But I just thought I'd take a minute to introduce myself. I maybe know some people on the call, but just in case, I am a VP of Homeownership Initiatives and President of Framework at the Housing Partnership Network, and HPN is a business collaborative of affordable housing organizations, and we were also the first national HUD intermediary. So for 20 years, we've been a HUD intermediary, and the Framework company emerged out of a commitment to a broad notion, which is one that I think Joe definitely shared just now with you all, that communities are strengthened when home ownership education is as natural a part of the home buying process as finding a realtor. And we partnered with our member, the Minnesota Homeownership Center, to build Framework on this philosophy of innovation and impact and sustainability and accessibility for the homeownership industry. And we said, we see the data, and we know that educated homebuyers are successful homeowners, but we also know that our industry is, kind of the best kept secret of home buying, and how can we reverse that? How can we make it so that we're no longer a secret, and that homebuyers come to us and they receive education differently. They receive it in a way that's really intuitive and interactive and mobile. And I think, we do really need to applaud the Fannie team for two things. The elimination of the PMIs from the Home Ready product is very powerful. And of course, the emphasis on actually coming out and saying it, HUD Housing Counseling. And then also the consumer fee. This is a really important first step for our industry to have this kind of idea that we have value to consumers and they should pay for our services is really essential to the industry ever sustaining itself. So we at created Framework to do what Fannie Mae really has described here, is increase the universe of mortgage-ready borrowers who access high-quality education. And so we created an affordable, intuitive 9-module course. It exceeds all national industry standards through the curriculum content. And we designed it from the very beginning to work through a very diverse partner network, again, with this goal of increasing the universe, of getting more and more home buyers online and educated. With high-quality education, because they are finding a lot of information about home buying online, but they're certainly not finding much HUD-approved curricula. So, just we have a really simple business model where we create for free links to Framework that you can use on your website. We've actually had a demo for this group before. We can do one again when there's more time, so we can delve deeper into how Framework works, or again, you can contact us at the partners email. But yeah, Framework is free to sign on. There's a 20% revenue share with our partner counseling organizations. You get marketing and administrative support from the Framework team. You have access to your data and your customers. And with Home Ready, we are building out a system, as Joe described, to ensure that there's post-purchase support for all of the Home Ready borrowers. And we're in the process of developing the criteria for the details on how we're going to roll that system out, and how much we're going to pay for that for post-purchase sessions. So more to come on that one. But you know, I think this is a really exciting development in our industry. It sounds like a fantastic product. I can't wait until it's rolled out, and I really hope that, you know, you all contact us and get a link to Framework up on your websites.
So do you want to say anything about what criteria agencies have to meet in order to be able to link to Framework and have clients?
So Framework is available to HUD-approved housing counseling organizations. In our contract, we have language about adhering to national industry standards and the National Industry Standards Code of Ethics.
And that's it?
We will be, and well, and you know, there's consumer privacy requirements that are embedded into our current contract, and we're going to be, you know, I'd like to have another discussion once we finalize our threshold requirements for the post-purchase around consumer privacy and information security, but I'm not prepared to kind of go into the details now.
Okay, so just let's separate these out. So in terms of groups using Framework in the sense that they would refer clients in to make them eligible to use the educational program and to make them eligible for the Home Ready product. So that criteria is simply they need a HUD-approved housing counseling agency, and they need to have adopted the industry standards. Is that correct?
Mm-hmm.
Okay.
That is correct.
And then just to make sure everybody picked this up, one of the features that you are working on currently is that after closing, Home Ready clients who some population in them, I don't know if they're going to be delinquent or what the standard is, may be referred back to HUD-approved housing counseling agencies. Is that correct? I think you might explain that a little bit. Yeah.
I think it's more simple. You know, I think so. What we're building here is, and what we've already been building. We have 95 partners current. Well, actually, I think as of today, we have more than 100 partners currently in the Framework network. And so these are partners and who, for the most part, are housing counseling organizations linking to Framework who essentially have your own subdomain. You have a unique link on your website. It's your Framework course with your clients in our system, and you can access all their information. And already we have organizations in our network who are doing really innovative work around post-purchase follow-up. So thinking of Framework as the very beginning of a long-term stewardship relationship. And so you can get in touch with your clients as you do in your regular business model. What's really interesting about Home Ready is that it's exploring, while not required, a model that really encourages and values that ongoing stewardship. And we want to make sure that if a homeowner that you've already built a relationship with, a Home Ready homeowner taps into your post-purchase services again, you know, they want to refinance. We don't know, we're coming up, but as you said, you know, maybe they're afraid of missing a payment, maybe they're already delinquent. We want to make sure that we can pay the fee to you for doing that for Home Ready borrowers.
And Danielle, correct me if I'm wrong, and be able to, if a consumer comes in through the link on, let's say, my local agency's
right.
site, and then subsequently they get a loan, they buy their home, and they call because they're worried about missing a payment, you can track them and refer them back to the agency that assisted them at the beginning.
Yeah, I mean, all of that data is in our system. I think the big things that we need to figure out still are, you know, how is Framework going to know that this is actually a Home Ready customer? So that's a Fannie Mae Framework question that needs to be answered. And also, but I do want to say that, you know, we are open, we are here to listen. And so if folks have ideas or sort of want to join a conversation around this post-purchase system, we're happy to do it, and we're always here to listen. And certainly we'll be doing that with the HPN network. But I do think that it would be this is the right time to start that conversation and really think about what that looks like for sure.
So let me just check in. So Matthew, have we got questions in the queue?
We have many questions. Yeah.
Okay, can I just say, I'm sorry, this is Danielle. I just want to say that I do have a hard stop at 2:30, so I can be on for a little while longer.
Okay, so why don't we
why don't we go till 2:30, Bruce, and then we can obviously do a follow-up. And as I said, there's a number of pieces of this this was an initial announcement. We wanted to let people know what we were thinking about and start to gather some input as we refine the details for implementation. So we can also do another round as well.
Good. Okay. So
so why don't we go quickly through some questions? So for Danielle, could you just explain kind of the incentive structure or the benefits to the housing counseling agencies, how it benefits them when they partner with Framework?
Sure. So right now, Framework costs $75 to the consumer, and there's no cost to the counseling agency to sign on as a partner. We provide a lot of support. We provide a lot of marketing opportunities and materials, and we provide, sort of back-end support and training, and then 20% of that upfront customer fee back to the referring agency. And then for Home Ready specifically, we're developing pricing for the post-purchase sessions, and a fee per session. So more to come on that, as I said.
Should be paid to the counseling agency.
Exactly, by Framework.
Great. I think that there's been many different kind of versions of this question for Joe. Well, there's a couple. First is what happens with a client who has already gone to a HUD-approved agency, either for home buyer education or for counseling. Is there any kind of plan in place to have that be substitute for the completing Framework requirement?
Yes, there is a. Go ahead.
Oh, okay. Well, let me. There's two different. Let me answer this in two parts. One is, as the product rolls out, there's going to be people that were in the counseling pipeline who, have just completed a course, and we obviously want to provide some transitional relief. It's not in the, it's in nobody's interest to say, starting today you must do Framework if you've just completed a home ownership education course or just gone through a counseling program. So we'll provide some transitional, a transition period. Haven't figured out exactly what the details of that look like to address people that are, in the queue now. The second part of this is, and where I really see, the thing that I think we're concerned about is the people that are going through a more intensive one-on-one counseling program as part of homeownership preparation. And the last thing we want is to have somebody who's maybe gone through a 12 months of intensive work and made a big commitment to counseling, and then to say, oh yeah, now you've got to do a course that duplicates something that you've already done. So we want to figure out a way to recognize that that intensive upfront counseling that's really not part of this program. But I think in general, going forward, we want to try to leverage Framework to the greatest extent possible because it does, it provides the quality and convenience and benefits to the consumer, and it enables us to best leverage the post-purchase support. So, I think we want to recognize that the different ways that people come into the system, but we also want to try to, drive a standard of consistency and streamlining.
Great. Let's see. Oh, so this is from Laura Buxbaum. So with when there's a non-resident borrower on the loan, how does the home buyer ed requirement apply to that person? Do they have to fulfill it as well?
Yeah, that's a great question. I think Christy had to jump off.
Yeah.
I'm assuming it does not, but let me take that one back. That's a good one.
All right. And for Danielle, what languages is Framework offered in?
English and Spanish.
All right. And then, so from the
So so if somebody's language is Mandarin or Tagalog, what's the piece to that? How do we handle that?
Great question, and I think this gets into kind of like a bucket of kind of the outlier bucket of people who need to have access to this product even if the online solution doesn't work for them. And so we're developing a system to make sure that people with these kinds of circumstances, language barrier, disability, something that is preventing them from using Framework, still have access to the product. So we'll create a pathway for them, a consistent one. And we have a toll-free line. The way we're thinking about it currently is there's a toll-free line for Framework that our customer service team can enroll folks into the Framework system, so that the big thing here is that we want to make sure that everyone's enrolled in the Framework system so that they have access to the post-purchase supports.
All right.
So it might be that they get, they get connected with, if they're coming in through Framework, they get referred to an agency, a HUD agency in their community that can provide homeownership education in Tagalog.
Mm-hmm. It's a HUD requirement that translation services are available, and and Framework has for those who are not connected to a HUD agency, or there isn't one in their area, in that off chance, we have a toll-free phone counseling system connected to Framework. So anyone has access to phone counseling, and interpreter services will be available.
Great. Real quickly, Danielle, could you just repeat the contact information people should have for you?
Yes.
We'll send it out.
Okay, we'll circulate.
It's partners at frameworkhomeownership.org.
All right. So there's another question about how Framework works along with the HUD-approved agency from the 9902 standpoint. So who will claim?
So what I really recommend, given the time, is folks sign up for contact partners, and then we're going to do webinar demos of the product, because the system was designed to be used for HUD housing counseling organizations, so there's complete connection to the 9902 data, and we make it easy for your homeownership advisors, counselors to report on the 9902 in the education category.
And I think the underlying question was, would the agency that does the referral get credit, or does Framework get credit under the 9902 for the education?
Oh, it's the agency's client. This is a tool. Framework is a tool that housing counseling agencies use. So, if an organization, NHS of Chicago.frameworkhomeownership.org, if a customer goes through that portal, then that's NHS of Chicago's customer, not, and they are reporting on the 9902. And HPN is an intermediary, so we report 9902 data for our collective network, not for Framework.
For Joe, when is the launch date for Home Ready?
Great question. The detailed guidance to lenders is due to be released on September 29th, and the features will be available in DU on December, I think it's December 12th. It's mid-December. So essentially, December is when lenders will actually be able to submit files and start to deliver loans. I think that the implementation time is going to vary a lot. Everybody's heard about what lenders are going through now with the implementation of the TILA-RESPA integrated disclosures. I think some lenders will be more aggressive. Others may lag behind. But I think some are already starting to build their pipeline.
Great. Okay, so also for Joe, so with LTV rate regarding loan to value at 95 to 97%, what's the required MI coverage? I saw it at 25% while my community mortgage is at 18%. Can you just explain that?
Yeah, so I was afraid somebody was going to ask a complicated pricing question. It has to do with the relationship between MI coverage and our pricing structure. So, and I'm probably I am far from the expert on this, but when you have essentially, because if the coverage level is greater, you know, our pricing is different to the lender. If the coverage level is lower, our pricing to lender might be a little bit higher. So what we look at is the, you know, moving the dials on the MI coverage level and our fees to the lenders to figure out sort of what's the best value to the consumer. And so in this situation, it actually works out better to increase the coverage levels because the all-in monthly payments are lower. I know that sounds a little bit counterintuitive, but because you know, one of the things we're never going to compete head-to-head with FHA, but you know, we look at that as a benchmark, and you know, that gets us a better value. And for some consumers, will actually be this product will price better than FHA.
Great. Maybe we'll just do one last question for Danielle before we lose her. I think it's a pretty quick one. Could you just talk about whether there's any fee to the consumer for post-purchase counseling?
In the current model, no. We are at Framework building out pricing models for a variety of next-generation products and tools. And so, you know, in the home-ready model, so the model that we're envisioning for this particular product, it doesn't look like it, but we can't answer that yet. Not a short, not a short answer.
I will, Bruce. For Fannie Mae, you know, one of a threshold issue though is that consumers should never pay for post-purchase assistance if you know, it's related to a financial hardship.
Absolutely. I mean, delinquency and delinquency counseling is different in our mind than kind of some other post-purchase services that I think homeowners are asking us for.
Other kinds of advice that's more, you know, of a type that it might make sense to charge for, so, but you know, one thing I should say is, you know, we're continuing our commitment to working with HUD-approved counseling agencies through our delinquency counseling programs, our post-modification counseling programs. All of that is continuing. What we're talking about here is really only related to Home Ready. And as I said, we're continuing to look at, you know, this is sort of not the last word. It's the first word. Figuring out how we can, you know, further leverage HUD-approved agencies, particularly in that early pre-purchase. Really, you know, how do we bring more people, more good qualified borrowers into to get access to homeownership, people that aren't able to access it today, and we see counseling as a key resource there.
And one question that I think is popping up, but we should probably just touch on is there are other providers. How do they fit into this? Other online education providers, how do they fit into this?
As far as Home Ready is concerned, we want to use a single provider framework. Other online providers, you know, offer services in the HFA. You know, we have a significant affordable lending business with the HFAs. The HFAs continue to have some significant advantages, preferential pricing and credit flexibilities, and you know, we're continuing to grow that channel, and the HFAs can continue to use you know, a wider array of providers. Likewise, down payment assistance programs that might result in community seconds delivered through our standard product. You know, we're not. This requirement doesn't apply in those arenas.
Guys, I do have to drop right now. Can others just call me? I mean, email partners if you need any questions answered, or if you want to link to framework. Thanks so much to Bruce and Matthew and everyone for joining today.
Very helpful. Great. Thank you, Danielle. Okay.
Thanks, Danielle. So, and I probably need to. I have a call as well, Bruce. And I just want to say I'm really just excited by the level of interest, all the great questions. You know, there's clearly energy around the product. We're going to look to this network and others to figure out, you know, how do we get this out to consumers that can benefit. You know, we're looking at developing collateral material, you know, that you could use with your clients. You know, but let us know what kinds of resources would be helpful in reaching the people that can, you know, most benefit.
Great, very helpful, and I think we're very interested in the. I think we're very interested in this idea of leveraging counseling more effectively and all this. Would love to keep that conversation going. I think, you know, there's a lot of interest in the field, especially in terms of creating more opportunities for our home buyers. So very helpful conversation. Understand that it'll be one that will be continuing. So thank you very much to everybody that's participated. And I'm going to quickly close out with a quick reminder that, you know, please consider joining NHRC if your organization hasn't already. We're working on improving the benefits to being members of NHRC. You'll have access to the foundation guide, which I know is quite an expensive $400 minimum, and you could easily pay more. We're going to get you access. Members will very soon have access to the foundation guide. There's going to be a bunch of other things. We're looking at a whole partnership with the Center for Responsive Philanthropy, which will expand what we have available. But, you know, people join because we're doing this kind of work, and we want you to be part of it. So we will pick up on a bunch of these issues in our next call in 2 weeks. We'll actually, I know some of you have been asking about this, we will definitely be doing more on the wealth gap issue and the role of race, ethnicity, and home ownership. And we'll have some interesting speakers and hopefully some more tools in that department. Big feature for us right now is that on student debt, on the student loan programs, we're going to launch a series of webinars. We'll train not just directors, but really counselors. So we'll have a lot of capacity. We'll have lines open for 500 people. We'll do 2 rounds, so we could do as much as 1,000 counselors, training them We'll have national experts in the field. It should be very, very good stuff. And we'll also bring in an advocacy conversation around that in a leaders call later in October. So lots of things happening, and we had Leah Coldham from HPN was scheduled to be on this call. We had rescheduled for her because there was so much interest in this call on HomeReady, but this is the whole idea of using Google Ads and Google Word as a way of promoting housing counseling, and we'll have her in a call in a few weeks. So anyways, lots going on. Please consider joining NHRC. Get the membership form on our website or just email us. You can talk to me personally about it. I'm happy to talk to anybody about membership. All right, good working with everybody. Thanks a lot for your input. This was a terrific call, and it'll be posted online in the next day or two so that you'll be able to hear the recording. All right, everybody, have a good Labor Day weekend. You earned it. Thanks a lot. Bye.